The so-called trade wars of 2025 have officially begun, and the markets have made their bets, even as developments change by the hour. Canada is going to get absolutely crushed. Interest rates there have utterly plunged along with the Canadian dollar. Mexico saw the writing on the wall and has already, at least temporarily, capitulated. The dollar is up all over the map, meaning many currencies, even those not directly related in the tariffs, are being slammed. Rates are down around the rest of the world too, in Europe by a bit more than US Treasuries. Now obviously, or it should be obvious, there isn't any inflation fear out there. Any impacts from sustained trade restrictions will end up lowering demand. There could be a temporary rise in prices, but once consumers adjust and start buying less, prices go down as the trade economy shrinks by however much it has to. The thing is, everyone knows this, at least outside of central banks. We have useful experience to draw on from the last time around in 2018 and 2019. The results from basically every academic study to just basic observation, they all conclusively showed that any price gains came at the expense of activity. I mean, it's just plain common sense. Why else do you think Mexico surrendered in a matter of hours? The Mexican economy is already in rough shape, having already forgotten how to grow just like everyone else. They can't afford another negative factor because it would send Mexico spiraling out of control. Canada is another matter. Weakness is there too, but it's somewhat less pronounced. And in many ways, though, trade wars could be a lot worse because of how much the Canadian economy will be negatively impacted. That's why bond yields up there have utterly plunged. And not just today, over the past 2 weeks, though there was another sharp drop once again today. There's no inflation risk, it's terrible economy risk, which was already high, goes that much higher. So what just happened today with trade wars? What do they mean? Where are they going? What do the markets all have to say? We've got a lot to go into today, starting with what actually happened. Well, on Friday, it was announced that trade wars were going to be affected, or tariff and restrictions were going to be effective on Canada, Mexico, and China. All goods that are imported from Canada and Mexico are going to be hit with a 25% charge, except for Canadian energy products, which were somewhat exempted with a lower 10% tariff. They also said there's going to be a 10% tariff on Chinese goods, and we'll talk about China later this week once the Chinese come back from their Lunar New Year Golden Week festival and see how the markets react over in China. But as the New York Times wrote, the auto and electric equipment sectors in Mexico are most exposed to disruption from sweeping tariffs, which is why they gave up pretty quickly, as is mineral processing in Canada, at least according to economists at S&P Global. There's also concerns, and they always bring this up, about inflationary pressures across the board. Analysts at Goldman Sachs have said if Mr. Trump proceeds with across-the-board tariffs, it would raise prices in the United States and slow economic growth. It does raise prices, but that's not inflation because it forces the economy to have to readjust to these negative non-economic factors. And in fact, what ends up happening is, yes, it slows down the U.S. economy, but it slows down economies around the rest of the world that much more, which is kind of what Trump has been betting on. If you're following what he's doing here, he's using this as leverage. Forget about the merits of the policy. In terms of pure economics, what he's doing is using this as leverage. He says, look, I know your economies are struggling. I'm going to add another negative pressure to them that you can't possibly afford. So get to the negotiating table and let's see what deal that can be worked out. That's the tactic here. And it's already succeeded, at least temporarily, with Mexico, though we have to be careful, and I'll go over this in just a minute. This already happened once, especially with regard to Mexico, back in 2018, where they were given a couple months to figure it out, and they actually didn't, and the tariffs did end up getting into place. But as far as Mexico, the morning wasn't even a couple hours old when President Trump took to Truth Social, where he said this: I just spoke with President Claudia Sheinbaum of Mexico. It was a very friendly conversation wherein she agreed to immediately supply 10,000 Mexican soldiers on the border separating Mexico and the United States. These soldiers will be specifically designated to stop the flow of fentanyl and illegal migrants into our country. We further agreed to immediately pause the anticipated tariffs for a 1-month period, during which we will have negotiations headed by Secretary of State Marco Rubio, Secretary of Treasury Scott Bessent, and Secretary of Commerce Howard Lutnick, and high-level representatives of Mexico. I look forward to participating in those negotiations with President Sheinbaum as we achieve a, quote, deal, put quotes around that, between our two countries. So already Mexico is saying, don't put the tariffs on if we can't really afford them. We'll give you some of what you want, and then we'll work out some other issues over the next month and hopefully avoid the tariffs. And in many ways, that confirmed a lot of what the markets were expecting, a lot of people were expecting, that this is all really a negotiating tactic to achieve other means. However, we also need to be clear. And President Trump has said a couple times, this isn't just about illegal immigrants or fentanyl. It's also about America's massive merchandise trade deficit, which will be a very much tougher nut to crack because you can't just reshore production given the labor market differential. So this, as much as there might be some daylight shining in here with what Mexico has been doing, there are bigger issues here that will be more difficult to really sort out, which is one reason why markets reacted so harshly to the news on Friday. As far as the Mexican peso is concerned, it had already fallen under 21 to the US dollar, which was its lowest exchange value going all the way back to March of 2022. And the Mexican peso had been on one of the few currencies that had a decent run in 2023 heading into 2024 because of all the nearshoring that was taking place in that country. The nearshoring, we look at the economic data, started to tail off heading into 2024, which leaves Mexico's economy in a particularly vulnerable spot because auto business is already weak. Mexico shipped a bunch of cars to beat the tariffs to begin with. So there's already negative cyclical pressures on top of the fact that with nearshoring slowing way down and being uncertain at best, Mexico doesn't have a whole lot of counter-cyclical support for an economy that is already showing signs of being incredibly weak. But after the news that Mexican President Sheinbaum has capitulated to President Trump and agreed to send 10,000 soldiers to the U.S.-Mexico border, the peso climbed back up above 21 to the dollar and got to 20.45, which is still a really low number for the peso and still suggests and indicates the market being highly skeptical about Mexico's prospects for the economy on top of whatever happens with trade wars. The real target here and the real pain is going to be for Canada. The Canadians, lots of trade goes to the United States. In fact, a huge amount of the Canadian trade goes to the United States, which again, Trump trying to use leverage to achieve his political goals. Trump took to Truth Social as well, talking about what his conversation had gone or how his conversation had gone with outgoing Canadian Prime Minister Justin Trudeau. Trump writes, Canada doesn't even allow U.S. banks to open or do business there. What's that all about? Many such things, but it's also a drug war, all caps here, and hundreds of thousands of people have died in the U.S. from drugs pouring through the borders of Mexico and Canada. Just spoke to Justin Trudeau. We'll be speaking to him again at 3 p.m. Eastern Time. So we'll see what happens in the later conversation. It'll take place after this video is being recorded, if there's any progress in the afternoon between the U.S. and Canada. But so far, the markets, like the economy, not taking this very well. In fact, a representative of Canada's auto industry said the auto sector is going to shut down within a week. That's president of Canada's Automotive Parts Manufacturers Association. That's what he said on Saturday. At 25% tariffs, absolutely nobody in our business is profitable by a long shot. And Bloomberg added, the duties would immediately hit almost 1/4 of the 16 million vehicles that are sold in the U.S. each year, as well as the parts and components that go into them. An import market that totaled $225 billion in 2024, at least according to research from consultant Alex Partners. Tariffs will add $60 billion in cost to the industry, the research shows, most of which will be passed on to customers, which we already know. This is how it works. So prices go up temporarily, demand goes way down. It hurts U.S. consumers to an extent, but it hurts the manufacturers in the country where the manufacturing takes place by a whole lot more. So nobody really wins from trade wars. It's an attempt to use, again, leverage to force some kind of negotiation and settlement on either trade matters or others maybe unrelated to economic considerations. But either way, trade wars are harmful to the economy. The reaction in the marketplace to potentially these restrictions going on in Canada Canadian dollar plunged, I mean plunged, overnight to 148 to the US dollar, which was its lowest exchange value since April of 2003, so more than 20 years. And then after the news that Mexico was giving in on some of the demands from the Trump administration, the Canadian dollar rebounded somewhat, but even at 146, slightly above 146, that's still going to be the lowest in over 20 years, even if it's not 148 or 150. And this is just what's happening today. So again, we'll see what happens with the phone call between Trump and Trudeau in the afternoon. But the Canadian market has already been decisively negative on Canada's prospects for a lot more than just this past weekend. It really goes back to January 14th. Just to look at what happened in the Canadian bond market. Canadian two-year bonds, the yield there had been 3.17% on January 14th. It had already fallen by roughly 30-some basis points to January 29th, and now we're talking 248 as of this morning, 2.48%, down another 19 basis points. So you're talking more than 60 basis point reduction in Canadian two-year bond yields in a matter of just a couple weeks. That's a massive amount. Lower growth and inflation expectations. And with the 2 years I talked about in a recent video, the 2 year we're talking about not just lower growth and inflation expectations, but also how the Bank of Canada, which has already aggressively lowered rates, is going to have to more aggressively lower rates to try to counter that level of economic weakness. At the 10-year maturity, the 10-year Canadian bond as of today is 2.95%, down 12 basis points. That's at last check before I started recording here. It had been 3.52% back on January 14th. So you're talking about almost a 60 basis point swing in the 10-year, lower growth than inflation expectations. Not higher inflation expectations, as you hear from some central bankers, including the Bank of Canada, lower growth than inflation expectations because common sense says you raise prices for non-economic reasons, like oil prices that we've seen during these oil price shocks. You raise prices for non-economic reasons. Consumers have to shuffle by cutting back spending in other places, either with the goods that are being targeted for the tariffs, or if they're basic essentials, they have to cut back in spending in everything else. So it leads to lower economic activity, which is not inflationary. So it might be some temporary impact on consumer price numbers, but it doesn't actually lead to inflation itself. You see lower interest rates around the rest of the world too. Like I said, we'll talk about China when China reopens. U.S. Treasury market interest rates are down a little bit there. German bond yields are down a little bit in Europe, 8 to 10 basis points depending on where you're checking. But some other currencies that are being impacted, India's rupee is a big one. That one fell, that one plunged too, down to 87.22 overnight, which is another record low, first time below 87. It has backed off a little bit since then, since the initial reaction. Last check, it was 86.97, which is also a record low, and it's down pretty substantially from Friday, which was 86.70. There's a higher risk premium, which means lower growth and expectations expressed as a currency exchange value, especially if this keeps going. There's going to be collateral consequences because this isn't just about Mexico and Canada and China and the United States. In fact, Trump even mentioned that he's considering tariffs on European goods and probably a whole bunch more beside it. So as far as the market is expecting, it looks a lot like 2018 and 2019. If you remember 2018 and 2018, central bankers talking about inflation to begin with. Along comes tariffs, which a lot of the financial market commentary said was going to be even more inflationary, lead to more rate hikes and higher interest rates, when markets were saying it's just the opposite. First of all, the global economy in 2018 and certainly in 2019 was already heading in the wrong direction, which should sound very familiar. So the global economy is already experiencing a substantial downturn. Tariffs happen. They weren't applied universally back then as they're being now, but it's the same principle at work here. Raise prices for some goods, reduces demand either for those goods or other goods beside it. So you had a bad economic situation that was made somewhat worse by the tariffs that were imposed in 2018 and 2019. But you heard all the same things. It's going to be inflationary. I'll give you an example. This came out in the middle part of 2018, where it was expected to be inflationary. For the U.S., the biggest burden may be a rise in inflation, talking about tariffs in 2018, potentially forcing the U.S. Federal Reserve to quicken its pace for further interest rate hikes. Trump's aggressive stance on trade has put the Fed in an awkward situation where it is forced to raise interest rates to match increasing consumer inflation. It sounds pretty familiar to what we're getting today, and it never happened. There was no burst of inflation. In fact, the opposite took place because of the bad economy, first of all, and whatever contributions from trade restrictions and tariffs were just more negatives on top of a whole bunch of negatives to begin with. In fact, you go back to the Federal Reserve and some other academic studies in 2019, and they came to that very conclusion. So why the Federal Reserve recently said, well, we're not sure what trade wars are going to do as far as inflation. All they really need to do is go back to 2018 and 2019. Look at the macroeconomic evidence. Look at the studies that were produced, including many by the Federal Reserve. Look at how markets reacted. Look how the economy evolved. Look at what they actually said and did. It was not inflationary. As then Cleveland Fed President Loretta Mester was talking about in the newly released transcripts from the 2019 FOMC meetings, she said in June of 2019, even firms not directly exposed to the tariffs express concerns that the renewed uncertainty will weigh on sentiment and investment. Some contacts are beginning to reassess pending capital projects, and some smaller firms are holding off on acquiring financing for new projects because of the uncertainty surrounding trade policy and tariffs. And she continued, some manufacturers indicated that the new tariffs will compress their profit margins more than the earlier tariffs in 2018 did because they have limited ability to raise prices, especially if demand softens. Indeed, price pressures in the Cleveland district have already eased since last summer, being 2018, with the majority of firms reporting they haven't changed prices in recent months. It's not inflationary. It's another headwind on the both local domestic economy and the global counterparts around the rest of the world. The trade partners, Canada, Mexico, China, Europe, and everywhere else, they get it worse. Now, back in 2018, I mentioned how this had already happened. The Trump administration had announced it was going to impose tariffs and duties on aluminum and steel in particular that was made in China, Mexico, and some other places like Canada, the European Union. On March 8th of 2018, the Trump administration announced that they were going to impose those tariffs, but they were going to delay them to allow more time for discussions. And so they took another couple months, took a couple more cracks at it, and by the end of May of 2018, they got no progress, and those delayed tariffs were imposed on steel and aluminum imports pretty much across the board. Anything coming from Canada, Mexico, Europe, and especially China. And you look back at the experience in Mexico and China in particular, as well as Canada, what you see is that 2018 to 2019, already those economies are experiencing a downturn, and then the trade restrictions reduce demand, and it adds more to the global mess. So it added more to the global pre-COVID recession, which is something I'm sure that the Mexican president, today's Mexican president, understands, Claudia Sheinbaum, which is one reason why she said, yeah, she capitulated that quickly. Understanding that the economics of the situation, regardless of the political agenda here, the economics of the situation are hugely unfavorable to especially Mexico and Canada. Like I said, we'll see what happens when markets open with China. But for right now, the markets about Mexico and Canada, especially Canada, have spoken. As I keep pointing out, the global economy and especially global trade, they've already been suffering. Talking about this forgot how to grow. It's not forget how to grow. It's economic weakness that is pronounced and protracted. So you've already got a bad economic situation, and then you add something like this on top. Sure, it raises prices for American consumers and makes it harder for them to buy, but there are blowback consequences on those producers who are counting on being able to make stuff and ship it to the U.S., which they know, as the Canadian automotive representative said, they know it's going to hurt and hurt badly. And again, that's what President Trump is counting on. He's using that as leverage. Whatever you think of his political agenda in terms of pure economics, the outcome, the likely outcome is absolutely clear. We went through this in 2018 and 2019. We saw all the same things that we're already seeing here today, not inflation, the opposite. The 2025 trade wars have officially begun. They are themselves a symptom of this world that forgot how to grow. But the reaction to it, the reaction from governments, the reaction in the marketplace, what they all suggest, big picture terms, an economy that's exceptionally fragile. That's why Mexico reacted. That's why Canada is facing what it's facing. That's why the markets are pricing what they're pricing. It's not a sustained recovery. It's not a robust economy. It is fragile. And everyone, including President Trump, knows it. US dollar's up, interest rates are down, gold is at a record high too. But that story isn't all about trade wars either, and I talked about that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.